Ladies and gentlemen, welcome to Friday Night Live. I am the one and only Mark Vittori, joined by my sensational co-host, Sean Floyd Pereira.
Whoop, whoop.
We need to get a proper UFC introduction, I think.
Oh, I think we got to hire Bruce Buffer. Is it Bruce Buffer?
Bruce Buffer.
Yeah, definitely not Bruce Jenner. That's someone else. So Bruce Buffer.
Don't want him.
Yeah, we need some Bruce Buffer to do. I think we'd have to pay him about $300,000 just for the speaking engagement, including a couple of business.
Rip out a bit of equity and do that.
Equity, yeah, we can do that with equity. Absolutely. But anyway, let's kick it off. It's Friday Night Live, ladies and gentlemen. We are so happy to have you all join us for another very interesting episode of Investment World 102. I had so much fun last week when we were doing this. And then maybe Mark will kick off with what we always kick off with, which is great. And that is, tell me, be honest with me this time around.
I will be.
How was your week?
It's been a bloody ripper, to be honest with you. It has been good, actually. It's been a good week. We've had a strong set of clients newly onboarded. So to those, if they are watching, welcome on board. I'm sure that is going to be quite a lot of value added your way from all of us here at JR. But yeah, it's been good. And yourself?
Well, my week was a lot less chaotic than it was the week before. That might change in the next few hours because we are heading into the weekend, and the weekend is where we work extremely hard, especially Saturdays, Sundays more and more.
That's right, we are. Yeah.
Lately for my end. So, but the week was good. Some phenomenal results for a couple of recent acquisitions. So I'm very happy to share about in the future. And the week overall was great. I think I enjoyed very much so Friday Night Live last week with Investment World 101. So much to the point that we collectively decided let's in good tradition, kick off with Investment World 102 this time around and get cracking into those questions that people have already sent us and people have asked us so that they can know a little bit about the behind-the-scenes mentality of how we like to think, how we like to function, and why it is we do exactly what we do and how we do it. So it's been phenomenal. But any other highlights that you'd like to share from your week in general, Mark, between last week and this week? I know last week we had the green signals behind me, which are still green. We've got the Luck of the Irish this week as well. So
Luck of the Irish, yeah.
Luck of the Irish is back, right? And we always love the Luck of the Irish. I mean, St. Patrick's Day is around the corner, which is March next year. So I guess it's just around the corner. But
we're lucky every day.
We're lucky every day. We were talking about this actually very recently. We're blessed in certain occasions. Very blessed.
Yeah.
So, good part is we don't take things for granted. At JR Prosperity Partners, we always like making sure that whatever the situation is, we are in the moment, present, and grateful, and ready to move on regardless of what challenges life throws our way. Isn't that right?
Yeah, you're right. Absolutely right. And I think, look, it's at least with any challenges that have been thrown our way this week, they've certainly been navigated professionally, I think is probably the best way to put it.
Yep.
But at the same time, they are something that is also a learning curve to us as well. And we always say that to our clients, like there are going to be things that we come across as professionals when we're working with our clients that we've never experienced before. Right? The world is a changing place at the moment, so we can't say that we've experienced this multiple time and time again. So, yeah, it's been good. It's been challenging but rewarding at the same time, to say the least. But we're ready for another week of Friday Night Fire. I think we should rename the segment now. A bit of Friday Night Fire.
It's definitely a bit of Friday Night Fire. Fireball. No, I'm just kidding. That's for probably Sunday afternoon at this stage. So anyway, we've got a fun list of questions from our extended audience that we did get submitted via email to our team inbox that I would love to share with the external people joining us tonight and our JR family clients as well. So we love you. God bless you all. All right, Mark, we're going to kick this off with you. So what age did you actually start your investment journey? Doesn't have to be only real estate based, but we're talking about any investment, general investments. What age did you actually start as Mr. Mark Vittori?
22, real estate, and it would have been about the year after that, 23, business. So,
whoa!
Yeah.
22 real estate, 23 business. Oh my goodness. Okay. A little fun piece of trivia for the audience out there. That 22-year-old piece of real estate, have we held it or have we disposed it?
Still got it today. Still got it today.
Okay. Tell us a bit about that and
look,
what it's used for.
It's doing its job. It's being utilised consistently, with equity gains, things like that, and obviously used to acquire more real estate, things like that. I've actually used it even in business as security previously. So I went, as they would say, balls deep in utilising that and having that as a piece of security to say, at the time that business that I was working on was it meant everything, and that was. Proof was in the pudding for me. Obviously not at the time. You never realise it at the time, but it was not until after the fact that I really looked at it and go, wow, really did put a lot there. So it's a bit of a sentimental hold, I think. It's seen a lot.
Looking back over time, though, saying 22, would you have gone back in time and rewinded the clock to make the situation getting into real estate at 28 instead of 22? Would that have served you? Would that have negatively impacted you, do you feel?
No, it wouldn't have served me at all. And it wouldn't have served me because of the fact that, it's only done what it's done. And I've been fortunate enough to do what I've done with it because of the fact that it was acquired as soon as I could get it.
Sure.
I did not think twice about it at the time. It was only a 10% deposit that was required.
Wow.
I don't believe I paid LMI, things like that either back then. So it was... of course, things have changed. I understand that. It's not always necessarily the same. And yes, it was a much cheaper price point than what it is in today's day and age and whatnot. And I get it. But it wasn't about saying, I need to buy the creme de la creme, or it's get in.
Right.
Get in. It doesn't matter what it is at the time. Get in. Now, of course, it doesn't always apply in every sense with what we do with our clients. But I think more importantly, those that are always sitting on the fence, as we always say, are a bit hesitant. Yes, you will get splinters in your ass, number one. But number two, you can't do anything. You're not going to make any gains. You're not going to get ahead if you're not in.
You're so right.
Simple.
You're so right.
Yeah. So something else I wanted to ask as well, Sean, was just in regards to yourself. Have you spread your money around with, I guess, multiple investment classes, or do you like to keep it down the line with one asset class, especially now at still a young age?
Yep. Okay. Good question. Very interesting. Have I spread the money around? I have. I have most definitely spread the money around, but not so much. When I say not so much, I'm heavily weighted towards investment real estate first and foremost, which has served me phenomenally better than the non-investment real estate. Let's put it that way. But that being said, I'm not a giant risk taker where I have a huge risk to reward ratio mindset in my brain. I'm someone who would rather prefer consistency, because I've learnt looking back that consistency beats the unpredictability factor of getting rich really quick. I've actually made crypto investments in the past, pre-current boom. I made it in the original 2017 boom, and I did make money. I remember having a flight coming up to Melbourne, not knowing where the money was going to come from, and I ended up selling a lot of Ethereum to get the flight and the accommodation paid off. So thank you, Ethereum, for that. And then since then, I never really got back into crypto ever. I bought a little bit of Doge coin recently as a test, and all of it just sort of disappeared, really, to be completely honest. But I'm a very old school investor in the sense that it's PE ratio. Don't expect too much on your divvies. Stay consistent, dollar cost averaging. So I do like shares. I really, really like shares. But do I like it more than investment real estate? Not really. I think with investment real estate, my philosophy is invest every time you can. With something like a share market sort of situation, I'd say create a bulletproof strategy up front, saying that you are going to do X amount of investment at post X amount of dollars every month, or every couple of months if it's really tough. The key is just sort of starting small and building it up. And in the span of 3 years, I've really surprised myself with the sort of share market portfolio I have. I have a bit of land overseas as well, which I was fortunate enough to enjoy back in 2017, which has done really, really well. No leverage required for that, so it made life a bit easier. So I have, to really answer your question, have I spread money around? Yes. But not to the level where I would be considered an extremely diversified investor. No. Standard banking stocks, maybe one or two in the mines, and then investment real estate in growth locations that have done really well. I've invested in locations that we actually help clients make money into. So yeah.
Look, I also say as well to a lot of our clients, it depends on your age as well. It depends on obviously what it is that you're looking to achieve. Now, assuming you are in, let's say, your 20s or 30s, realistically, I think we should be looking at growth. That's how I always see it. I don't think we need to be focused on too much of, cash flowing ourselves and things like that. Everyone wants to be in this position where they're not having to lift a finger anymore at the age of 35. Well,
right.
Unfortunately, we don't live in.
Maybe you and I can do that, but not everyone can do that.
Correct. But it's something that certainly isn't the case for the average Joe. And sometimes you've got to come to terms with the fact: are you an average Joe or not? And you can get out of being an average Joe. You just need to do it the right way, and the right way is a little bit longer, unfortunately. So I think there is certainly a lot of. Everyone feels as though they've got this secret sauce. I think we deal with it quite a lot. There's a few people that always just tell us that they're so, they know what they're doing and they're earning well. But you strip them away from their income from work.
Yeah. And there's about like 2 months of sustenance or 3 months of sustenance, and then that's it. They're back to square one.
That's exactly right.
Just painful. All right. Well, I've got something for you now, Mark. So how much risk are you actually willing to take? When I say how much risk are you actually willing to take, I know everyone's circumstances are very different, but just for you personally, how much risk are you willing to take?
Well, I think we spoke similar question on this last week.
Very similar.
And, I think it was more about, at a certain age, when did I take risk, things like that. But how much risk am I willing to take? A fair amount. I've always been like that. I think it's just, sometimes it's either in your blood or it's not in your blood.
But when you say you're willing to take a fair amount, what I wanted to really understand here is a fair amount, sure, fair enough. It sounds great. But does that mean you're willing to have a zero, are you willing to have 100% loss of initial capital? Is that the sort of risk you're talking about? Or are you saying that if there's X amount invested, a lot of risk, or being able to take a lot of risk, is being able to walk away with 50% of that initial capital? That's what I wanted to figure out in terms of what level are you talking about?
Pretty good question. Yeah, pretty elaborate there. I think it's
Apologies for the poking.
No, but I think it's when I think about it now a little bit deeper, no one wants to walk away with nothing. No one gets into any form of business or investment to walk away with nothing. Right. For me, I have done that in the past. I have walked in and put a bucket load down and walked out with nothing. So after experiencing that, I thought to myself, well, guess what? You bounce back again. And it gave me the mental resilience to kind of look at it and go, well, yeah, you know what? Whether interest rates are up, down, sideways, as we always say, who cares? For example, in real estate, if we just talk real estate, get as much debt as you can get, because it's only going to leverage yourself and maintain that debt. That's how I see it, and I don't expect everyone else to see it. But for me,
that is absolutely how I see it as well.
For me,
as long as it pays for most of itself.
If you understand debt and you understand it here in the country, you understand that it is it's the way to become wealthy. Right? Unfortunately, it is the way to become wealthy. Do you need to clear that debt when you're 35, 40 years of age? No, you don't. But do you want to have that debt at 70, 75 years of age? No, you don't.
It's like the question that people going, well, how do I pay all these properties off? Well, you buy more properties so that they can pay off the other properties. But then how do I, get in touch with a real strategist?
Exactly. But look, I'm willing to take a lot. And, I guess that brings me to a question as well that I wanted to ask you. Yeah. And that was, what can you afford, Sean, to lose?
You're talking about me in life? What can I afford to lose? I can afford to lose. I can afford to lose deadbeat friends. Yeah. I can afford to lose a few kilograms off my belly. I can afford to lose the bad eating habits. Yeah. I can afford to lose a lot of things. Now, because we're in Friday Night Live, I'll talk investments. So what can I really afford to lose? I can afford to lose active income. I can afford to lose about 50% of that. And still survive. When I say survive, I won't be thriving, but I'll survive. Yep. And I think people should learn to live a frugal lifestyle before they go out there and become extravagant. I feel people need to really learn to master this. What can you afford to lose in the investment world? Because my expectancy is, I think we discussed a little bit about this last time around, Investment World 101's episode. By the way, guys, if you haven't seen that, I'd highly recommend checking it out. It was really fun, short, sharp, to the point. Yep. we'll probably leave a link of it somewhere in here, or definitely in the comments below, or you can just jump on our channel, subscribe, and we'd love to have your feedback there. Yep. But what I feel is important is the expectancy factor going into the investment journey. So I'm talking about the expectancy factor going into the journey. Stocks, we know that with a combination of capital growth and a bit of dividend yield, you should be getting your 8 to 9% or 7 to 9%, right?
Yep.
So my stocks have way outperformed that benchmark. So tomorrow, if I lose, let's say hypothetically, what has performed at 25%, if I lost a lot of money in the stock market and my overall performance went down to 7%, I wouldn't be doing any panic selling. I'd be doing opportunistic buying, right? I'd be buying more. So I know that it's a patience game. Yep. It's almost a transfer from the impatient to the patient. Real estate, investment real estate have already done so well in terms of original purchase price, equity on completion versus equity in today's market value, phenomenally well. So I'm okay to lose 50% today of all the gains I have ever made, and I will be ahead still from what my expectations were going into those investments. That's the powerful part.
Very interesting.
So that means, are you weathered for the storm? For some person, a storm might be a 5% hit. Yeah. For some people, a storm might be a 50% hit. I know with our founder, Jack Kumar, who's running multiple hats, growing and scaling multiple businesses, that's someone who's been able to take hits on a scale that people would not even comprehend. They would laugh at you to say that, why are you still in business? It's that tenacity with planning and having a investment horizon that's realistic, but at the same time, a bit of thick skin to go through the tough times without panic buying. Because we spoke about it with the share thing last time around about if you were to buy when the media told you to buy, your results would have been here. Versus if you just dollar cost average your whole life, your results would be here. Yep. So I hope that makes a little bit of sense to what you were looking to figure out.
I hope it does too. So I actually wanted to ask another question, and I think I'd like to also answer this on the same time as well. What is your time horizon? I think that's an interesting one.
Oh, you're asking me two back to back?
Yeah, I'm going to ask you back to back.
Okay.
It's about your time horizon.
No, actually, to be honest, 9 months is my investment horizon. That's how long it takes to make a baby, right? That's just a general knowledge fact. But anyway, I'll let you finish the full question.
No, that's my question. So obviously, What is the long-term gain or even the short-term? Let's ignore the short-term for now, but the long-term, is there a deadline in place? Are you going to be a certain age? Are you going to hit a certain threshold of assets? Are you going to aim for a specific number, dollar amount number that for you says, right, tools down, no more investing, I'm done and I'm living the rest of my life out with what I've got and done and dusted?
Great question. See, this is the constant internal battle that I have all the time. As I've grown older, I'm fortunate enough not to be too old yet, but as I've grown older over time, I've always considered myself an old soul, thinking about things in a very mature way, always been very ahead of my years. You can ask peers from even 10 years ago, and it was the same situation. I actually knew Jack about more than 10 years ago now, so he'd say the same thing. When I was really young, my answer was yes, there was a exit. At a certain age, it would have been between 35 to 40. There would have been X amount of passive income. And get out of it, get out of the game, get out of the chase, and just enjoy on the boat, enjoy on the yacht somewhere. As I've grown age-wise and as I've grown experience-wise, I've just come to the realization that sometimes in life, you just being in a certain line of work gives so many more opportunities to other people and other families that you don't see on a day-to-day basis. When I say you don't see it on a day-to-day basis, just by working, having good work ethics, being in a property game, helping a family do something, create 300 grand in 3 years that they would have never been able to save. The impact that you've had on their future generations, their mental livelihoods, their familial relationships is so positive that it's encouraged me to think bigger. When I say think bigger, always thinking bigger. So whatever goals I have today are probably, I would say, around the biggest I've ever had. But when I was young, I never thought I'd be where I am today. But as I got older, I realized I can keep stretching that limit. So to answer your question, when will that ever be enough? I think the passive income exit will always be there at a very early age for me. But that choice of whether you'll take it or not, I would say today 90 to 95% very sure that I will not just up and leave. As we say, I ain't leaving, you ain't leaving, producer Ryan, you ain't leaving, Mark. We say we ain't leaving, but I really don't leave because I feel that you as a human being will always need something to strive for, to thrive for, and pick your next big thing and just go for it. As a business owner, sure, I get it. In terms of just your general passive income exit strategy, I think that'll be a possibility fairly soon. But would I do it? No. I've recently, I would say over the last 4 years, come to the conclusion that I wanted to ride it out by always setting the next big thing and creating a new anchor to work towards something bigger. Because to be honest, I was not one of those people that needed to have a chip on my shoulder for anything. I was very blessed growing up. Very blessed growing up. Very fortunate to have the people around me at the time I did in my life as well. So I think for me, the idea is to create our own version of that chip, put it on there and work hard, deliver and move on.
Nice.
Hope that makes sense.
No, it does. It does. And when you reinvest your income that you're currently making from work.
So I'm getting a triple header here back to back, am I?
Oh, I'm just keeping the flow going.
I love it. Okay, will I reinvest my income? Absolutely I will. Absolutely I will. Not a doubt in the world. Why I say absolutely I will. Sorry, I was just fixing my mic. It was just being a bit funny. I will reinvest my income to the level where I think good money habits will always keep going, where if your share market strategy is based on a net monthly amount, post-tax, a month that you're putting into the markets, I think that if you stay consistent in terms of your approach of investing active income consistently for at least 10 years, what happens is the passive income stream from that original base becomes so strong that you can have things like dividend reinvestment plans. With regards to property, would I reinvest? I've already done it, which means taking equity from somewhere and putting it into something else to create more equity. I don't think I'll ever stop reinvesting. But actually, no, I take that back. There'll probably be a time period where I will end up stopping reinvestment once it gets too big. And my only reinvestment strategy will be back into the business of JR Prosperity Partners, because I'm actually more passionate about building my team's, capabilities of how many people they can serve, more so than just collecting properties on the side. This year I could have picked up a couple of things where I thought I'll go slower, I'll focus a little bit more on the business, but I'm still going to collect something very soon. I think I told you about that opportunity that I was thinking about personally for myself. I will pick up something small over there, which I'm looking forward to, but my real passion is reinvesting back into this culture that we've built, that we've fostered over the past few years, and you and I have been through so many things already in the short time that we've been together, and I just can't wait for what the next 5 to 7 years holds. I think we'll be mushrooming into something very big, and we're fortunate to have awesome people along with us on the journey as well.
I agree.
Yeah.
And
let me jump on the question trail. I want to fire one at you for sure, and I might surprise you with this one. Okay.
Right,
do you have a plan for putting away either savings or equity? Do you have a specific plan for putting away your own savings or equity into something else? What's your investment strategy, Mark?
Yeah, it's a good question.
Ooh, we're going to hear it on the other side today, ladies and gentlemen. Get excited.
So, do I have a plan for putting away more savings? So I think it's a known fact. Everyone loves to have cash in the bank. Everyone likes that feeling. Gives everyone that sense of security, and that's fair enough. It's a question I actually had with a close friend of mine, probably about 2-3 weeks ago. Just randomly, had a couple of beers, having a laugh, having a chat, and we basically were just having a talk about. He's done really well in real estate. He's bought a handful of properties, over the last couple of years alone. But before that, he had multiple pieces of real estate and continues to acquire. And I think the same question kind of came up in saying, what would you do? Would you liquidate? He goes, if I liquidate, he goes, I'm just going to blow it everywhere. I'm going to spend it on things. I'm just going to waste the money. And I said, you know what? It's probably a human habit that we all fall into that trap. Because consumer trap. I mean, yeah, you might hoard the cash, but you're going to do one of two things. You are either one of two people. You are a very conservative hoarder, which doesn't get you anywhere, or you're a spender, which still doesn't get you anywhere.
But at least it'll be fun to pass the time.
Yeah, it will, of course, correct. But he basically said, look, I just, he goes, I could stay liquid, by a few $100,000 every year and do the, and he goes, I just park it into real estate because I just almost don't trust myself. And I thought that was an interesting conversation I had with him. And I think the same has applied to me over the years as well. Like, and I look back over the many years, even business years, things like that. And I always noticed one thing was that, I always used to say it to myself, be asset rich and cash poor. Now I look at it from a subconscious perspective, and I'm like, I know why I was telling myself that is because I was like, if I get a lick of too much cash, it is going on things that are not going to serve me a financial return. They're just going to be, may as well go down to the drain down there and put a couple of $100,000 down there. So
at least you've been making the plumbers happy.
But yeah, look, I think, to answer that question, in a more wholehearted way, do I have a plan to put away more savings? Not necessarily. I'd rather put that savings into an asset of some sort, whether it's stocks, whether it's shares, whether it's real estate. Of course, you've got to save to park into real estate. I understand that. But let's assume you've got a handful of real estate right now. If we're talking to some of our audience out there, put maybe some of that into your mortgage, some of that cash, reduce that debt. That give yourself more equity.
Part.
Yeah, well, correct. So that you can recycle that equity in the next 12 months' time, because guess what? There's going to be a time where banks will sharpen up again, and that's the time we go again, right? And that is something that I probably look at doing is always seeing how I'm looking at the next move. I don't worry about the next 12 months of savings. I worry about the next move and what does it take to get there from a dollar perspective. And then once you've got that amount, execute, done. And then focus on the next thing, and then that's
don't drag the execution.
And you're pretty much in this wheel of your own rat race, we'll call it, but it's a good wheel of rat race. Because you are doing it with a purpose rather than just working and doing after work beers on a Friday and things like that and repeating it every week. So
exactly.
But
did you have a little teaser for me?
I do. Yeah, if I can.
Our conference that we are probably getting a bit late to. I would say probably.
I do. I've got another one for you.
Okay,
and it's a little bit of a. I like to call this one a bit of a nerd question for us property nerds out there. So have you factored in inflation into your budgeting when it comes into your investment plan?
I've actually factored in inflation for all my clients' plans.
Yeah.
Not for my own. When I say not for my own, not to the extreme levels of your 4% and whatever.
Yeah.
I keep it fairly standard at the benchmark of where we try and be, which is within that 2.5 to 3.5 mark. So I haven't been as aggressive in factoring inflation for myself. I always look at leverage. When I say I look at leverage, if I leverage the right way, I don't have to worry about inflation. $100,000 doesn't buy you a $100,000 property. It buys you a $800,000 property if structured correctly, i.e. house and land or save stamp duty, whatever. And even if that property only grows at 3%, your return on investment is 24% return on cash. So unless we have inflation that's going to be 20% in the near future, which it won't be, I'm guessing, especially with all the curbs that are going on, we'll be okay. So that being said, I don't really pay a lot of active attention to it at all. I don't. I know it's something that's part and parcel, because what's the alternative? There is no alternative. It's invest or die. It
really is.
Or, well, everyone that has invested will die anyway.
Yeah,
so at least
right.
might as well invest and then die.
We're going one way.
Round. Exactly. Yeah.
Round robins.
It's time for the rapid round robins, ladies and gentlemen. Paulina, can you add some music for us? All right, that'll be fun. All right, rapid round robins. You've got to be really fast on this one, Mark. Are you ready for it?
Quick draw McGraw.
Oh, okay, I like it. What's your favourite beer and why?
Ooh.
Greek.
I'm going to tell you, and it's something that's not very common. It's called Lubser Lager.
Lubser Lager.
And it is German.
Wow.
And the last time I had it was in Germany back in 2016, so a while ago now.
Wow.
And ever since that day, it just had this beautiful, crispy, bubbly taste.
You know why I asked this for tonight's Rapid Round Robins? I had another set of questions that I was going to ask us next Friday, which I will still do.
Yeah,
but it's because you said you got that honest conversation time with one of your friends over a couple of beers.
Yes.
And there's a lot of people out there that don't have people they can trust, people
Yes.
they can speak to.
Yes.
I just want you to know that if you need to pluck up the courage to ask a mate out for a beer, maybe a lobster lager, just do it, because getting things off your chest, don't bottle everything up here and don't bottle everything up here. Life is a beautiful, beautiful thing. You're meant to enjoy during your time. You're not meant to be suffering in silence. So anyway, continue.
Looks lager, no, that's all I got to say. It was a
Fantastic.
beautiful beer.
Fantastic.
It was very, very yummy.
Great.
And you?
Well, for me, it's the Stone and Wood Pale Ale. Thank you, Harry, for that recommendation way back in 2019. Before that, before 2019, I probably had all about 5 beers my whole life.
Yeah, wow.
And then after 2019, I enjoyed Stone and Wood Pale Ale, which later then we had a couple of clients that were affiliated with something to do with the brewery house of that beer as well, and then I started just falling in love with it. So that pale ale crisp, it feels like you're drinking fruit juice half the time. So
You know what? I must admit, I'm not a fan of the pale ale.
really,
I'm a lager man. Yeah.
I think you are. I think you're more of a lager man for sure. Boys on the beers is a topic for a different day, which we'll get to. But tonight has been an absolute pleasure, ladies and gentlemen. I'll maybe let Mr. Mark Vittori wrap up the show for this evening.
Yeah, the boys, Friday Night Live, brought to you by the one and only Mark and Sean, and we are here to help you get ahead in life.
Have a great week, ladies and gentlemen. We are very late to our conference. See ya.
Bye.